Good morning, everybody. I am Dr. Ghulam Mohey-ud-din, a senior economist basically from Pakistan. From last 2 years, I am here in the Saudi Arabia, and it's a pleasure to speak to you all today about something that I believe sit at the heart of the modern technological progress, the economics of quality. What we talk about technological leadership, we usually think of innovation, budgets, R&D, or the patents. But real question is why do the countries like Japan, Germany, and South Korea sustain technological leadership decade after decade, long after other catch up in innovation spending? The answer lies in what I call quality economics. That means treating quality as a capital, not cost. So, the technological leadership is not just about invention, it is about systematic excellence. Quality is not a box ticking exercise or a compliance cost. It is a form of economic investment. It's what allows firms and even nations to build reliability, efficiency, and customer trust, all of which are the prerequisite for sustained leadership. So here are the core idea for today. Quality is capital. It enhances productivity, reduces uncertainty, and multiplies innovation returns. So let's look at the economics behind this idea. Think of it as a simple flow. Investment in quality leads to productivity gains, which leads to technological leadership. So Economist refers to this as a building quality capital, a stock of intangible asset that functions like human or the physical capital, but with even greater compounding effect. When companies invest in quality systems, trainings, and process improvement, they are not just preventing defects, they are building productive capacity. This shows up in the total factor productivity or TFP, which measures how efficiently economies convert inputs into outputs. High quality firms and nations have higher total factor productivity, meaning they generate more value from the same resources, and this aligns perfectly with the Schumpeterian and the endogenous growth theories, where innovation, diffusion, and learning are the key engines of long run economic growth. Now, what exactly is the quality capital in economic terms? If we talk in specific economic terms, it is a form of capital that embodies innovation and efficiencies. Robert Solow once described technology as a kind of jelly capital, which is always evolving and adapting. Quality works the same way. Unlike machines, quality system doesn't wear out quickly. They compound over time. Firms that invest in quality definitely see higher output per unit of input, slower depreciation of value, and sustainable competitive advantages. These benefits go beyond productivity. Quality reduces waste, enables premium pricing, and raises market entry barriers. So, in short, quality capital plays dividend that the physical capital never could. How quality generate value? Now let's connect this to the real economic outcomes. There are the four major mechanisms through which quality creates value. First, efficiency, as the quality reduces waste, defects, and transportation cost, and it helps you do more with less. Second, reputation. High quality firm earn consumer trust and loyalty, allowing for the premium pricing and brand power. Third is the innovation. Quality management fosters learning, process improvement, and technological spillover across the sectors. And fourth and lastly, the competitiveness. Quality standards open doors to advance global value chains, where together these mechanisms form a virtuous cycle. Innovation leads to quality, quality reinforces competitiveness, and competitiveness sustains innovation. That is how nation moves from catching up to leading. Now, let us see how this plays out in the real world. In Japan, the philosophy of Kaizen, the continuous improvement, turned the nation from low quality manufacturer in 1950s to the world leader by 1970s, only through total quality management, just in time production, total productive maintenance. Japan made quality its national identity. In Germany, the approach is systematic and institutionalized through ISO 9001, EFQM excellence model, and Industry 4.0. Here, quality has evolved into a real-time, data-driven excellence. Quality is not a separate department. It is built into every digital process. In South Korea, the story is about collaboration between government, industry, and technology. They created quality alliances that linked innovation with policy and production. This shift from government led to an industrial driven quality model helped Korea become a global ICT leader. So, across all three cases, quality investment came first, technological dominance followed. What this all means for emerging economies? It tells us that the real development gap is not just capital or technology, it is the total factor productivity. And quality drives that productivity gap. Three lessons stand out. Invest in quality infrastructure, standards, testing and certification, etc. And secondly, build a culture of quality where improvement is continuous and everyone is accountable. Strength. Third, it strengthens collaboration between government, academia, and industry. In simple terms, nations that produce quality ends up owning technology. For policymakers, the implication is clear. We need to move quality from being seen as a regulatory burden to being recognized as a strategic investment That means investing in national quality infrastructure, metrology, standards and accreditation systems, linking R&D with the quality initiatives so that innovation translates into reliable products, supporting SMEs, small and medium enterprises, to adopt quality management tools, embedding quality education in universities and technical training, and finally using quality benchmarking as a measure of competitiveness. Ultimately, the key performance indicator for any economy should be how much quality capital it is accumulating, because this is what drives long term productivity growth. So let's wrap up. Technological leadership is not born from innovation alone. It is sustained by quality economics. Quality investments create multiplier effect, boosting efficiency, innovation, and trust for all at once. When nations and the firms start treating quality as a capital, they build assets that compound, systems that learn, and the reputation that endure. So, as often say, nation that treat quality as a capital, not cost, lead the next wave of technological advancement. Thank you very much for providing these opportunities. Thank you very much again.